Afternoon, ladies and gentlemen. Welcome to the weekly wrap-up for July 1st, 2022. I know y'all have probably missed me over the last 2 weeks while I've been at the Pork Fest over in New Hampshire and then driving back. So got back, I guess, Wednesday, but just didn't feel like getting started yesterday. I was trying to do a lot of catch-up on office things yesterday. So had a great time in New Hampshire. The weather was pretty good. Didn't get any major rain. Got to see a lot of sights, a lot of libertarian hippies everywhere. But it was a lot of fun, and got to tour some cool places. Went over to Montpelier over in Vermont. Wasn't too far, about an hour away from where we were staying. Toured the Capitol building, or they call it the State House in Vermont, and went to a museum, and also drove over to Maine for a little bit just to say, hey, I've been here. And but anyways, long drive. It was about 2,100 miles each direction, and I am sore and tired from sitting in my truck for, well, I guess it took us. We left very early Saturday morning, and we got there Monday afternoon, and then we left Sunday morning of this week, and took our time a little bit. We stopped in the Finger Lakes in New York on Sunday night, and stayed in a campground this time rather than just stopping in the rest areas for a few hours and sleeping on the couch in the fifth wheel. So it was a little more restful to pull in, hook up power, watch TV, have a decent meal. And then we stopped then the second time on Monday. I guess it was west of Indianapolis. And then Tuesday, we stopped at a friend's house in St. Louis, or in the St. Louis area. They live kind of out in the boonies, which is very nice for me. And so we stayed there, had some, went and had dinner. Thank you to Mark and Gina. Your hospitality is greatly appreciated. I can't thank you guys enough. Y'all are the best. Mark is a fellow shipmate of mine back in my Navy days, and he's actually the reason I met my wife. So I have a lot of thanks to him. Today is actually the anniversary of Leslie and I meeting back on July 1st, 1995. So my wife hardly watches these, so this will be a clue if she actually watches this one this afternoon. She's off doing some things right now. So, but yeah, 27 years she's put up with my pain in the ass self. So either she lost a bet at some point in a former life and got stuck with me, or she won the lottery. I don't know which. So anyways, all right. Well, again, I hope everyone is doing well out there. I apologize for, I was hoping to do some videos while I was gone, but I was just having too much fun. And, I was still getting work done, but I just didn't feel like setting up the camera and getting everything all ready. And then, anyways, so not a great week in the market. And, today kind of salvaged the ugliness that we saw most of the week. But, if you've been watching these videos over the last year, and especially since the first of the year, since things really started to trend in a negative direction, what's happening this week is certainly not a surprise. So, sorry, Ryan, I don't have a joke today. I had nothing prepared. And I had a lot of stuff to talk about in the first one. My older boy, Ryan, thinks I should be more humorous in my videos. And also, other big news while I was gone, my younger son and his wife had a baby. So Isla Virginia Dahlman was born on June 20th, which was Monday a week ago. So I am officially old, according to my younger son, and we are officially grandparents, which makes my wife very, very happy. She's headed off to Florida. Drove all the way back from the East Coast, only to fly back today to go spend a weekend with my son and daughter-in-law and their new baby. So I'm staying here with the dogs. I couldn't, too much trouble to board them and all that good stuff. And I didn't really want to drive from New Hampshire down to, South Georgia, where he's stationed, and then have to drive all the way back across the United States. So, that would have probably added another, probably 1,200 miles to our 2,100 trip back. So, but the truck did like a champ, great, not great gas mileage. There's a lot of hills across Kansas, and the prairie is pretty rough with the heat. When we were coming across Kansas on Wednesday, it was over 100 degrees, and it's a rough drive driving west. I mean, the motor is definitely under a little more strain than on the flatland across the Midwest. So, all right, well, let's go ahead and dive into today's news. Or let's check in and see how the major indexes did today. The Dow Jones finished up 1.5% or 1.05%. It's currently sitting at 31,097. The SP 500 up 1.06, and it closed at 38.25. Nasdaq up 0.9, closed at 11,127. Small caps are up over 1% also. The VIX pulled back 7% today. It's currently at 2670. The other exchanges in the Americas, Canada was down 1.14, Brazil up 0.42, Mexico up 0.61. Headed over to Western Europe, Germany up 0.23. UK was flat. It finished down 0.01. France up 0.14. Euro stocks down 0.19. Netherlands down 0.54. Spain up 0.96. Italy up 0.29. Switzerland up 0.27. Portugal up 0.12. Belgium up 0.71. Let's move down a little further. The Russian exchanges, the MOEX was up 0.08, so basically flat, while the RTSI was down pretty significantly, down 5.09% today. Moving over to the Asian markets, Japan finished down 1.73, Australia down 0.43, New Zealand down 1%. The Shanghai was down 0.32, the SESC component down 0.28, the China A50 down 0.53, the DJ Shanghai down 0.38, and the Hang Seng came in down 0.62, and the Taiwan weighted was down 3.26%, kind of the outlier across the Asian markets. So mostly a down day, it looks like, across Asia, up or mostly up, not a whole lot, but in Europe, and then we had a pretty decent day. And actually the U.S. markets were actually down most of the morning. So if you were watching it all day long, it is a bit of a nice surprise that things finished the day in the green. So unfortunately, the week is not the same. Let's go ahead and take a look at the weekly returns on the Dow Jones. Let's see, it came in, finished at about 1.39 down. The S&P 500 came in down for the week about 2.4%. NASDAQ looks like it finished off the week at down 4.77%. Dow Transports down 2.47. And the lone outlier that looks like it had a good week was the Dow Utilities. Looks like it finished up 4.4%. So not the best week in the markets, but again, these things do happen. Again, let's pull out and look at the longer term trend. Right here is the beginning of the year. I think this was January 3rd or 4th. And you can see that was the high mark of the Dow in this last uptrend. And again, we've been following this resistance line downward for the last 6 months. So we'll see, eventually we'll break this trend, but, will it be this year? I don't know. Will it be next year? More likely. But I think we'll probably have to really feel the pain of the recession that we're headed into before we'll actually see some relief and an uptrend again. So, but again, these are my opinions just based up, upon looking at the technical analysis. So, all right, well, let's go ahead and read through this week's economic data that came out. First one up, U.S. initial jobless claims came in at 231,000. The forecast was 228, so just a smidge over forecast. Looking down here at the previous weeks, the last time we were below 200,000 was the last week of April. So since then, we've been in the 200 to 230 range for the last 2 months. Continuing jobless claims came in at 1.328 million. The forecast was 1.31. So again, slightly over forecast, but again, I wouldn't really consider that the end of the world. We've been basically in the 1.3 and change million continuing claims going back to the beginning of May. The trend has kind of leveled off, which again, looking here at this chart, it's about where we were 2-3 years ago. Some weeks we were as high as actually we're a little lower than we were headed into Corona, but again, not really worried about that. Jobs are a lagging indicator. You'll see businesses start to slow down and lay off people. The writing will be on the wall well before we really see the jobless claims numbers change. U.S. durable goods orders month over month came in at an up or a positive 0.7. The forecast was a positive 0.1. So I guess that's some good news there. Consumer confidence came in at 98.7. The big brain people thought we were going to come in at 100.4. So, but looking at the trend, since was this June of last year, which was kind of the peak, after all the COVID junk, we've been on this kind of slow, steady decline. We're certainly not as low as we were 2 years ago at this time, where the consumer confidence was in the 80s. But, again, looking at everything in front of us, I think it's probably going to continue to fall for a little bit. All right. U.S. GDP number for first quarter was revised down again to negative 1.6. So that's not some good news. And from what I've been seeing, and we'll have more on that in a little bit later in a couple articles I have, looks like the GDP numbers for second quarter are not going to be much better. So the ISM Manufacturing Purchasers Managers Index came in at a 53 even. Forecast was 54.9. And we can see here over the last few months, we've gone from around a 60 number at the end of last year, and we've slowly been creeping down ever so slightly the last 6 months. All right. Well, let's go ahead and read through today's market recap. It's S&P 500 climbs as rising consumer stocks offset chip-led dent in tech. It's written by our friend Yassine Ibrahim from investing.com. Let's go ahead and jump into this. The S&P 500 cut losses to climb higher Friday as a jump in consumer stocks offset a chip-led dip in tech following weaker guidance from chipmaker Micron. A more than 1% rise in consumer stocks helped the broader market turn positive after home builders surged as investors price in a less aggressive Fed rate hike in July. Well, that'll be determined. Pulte, Lennar, and D.R. Horton Inc. were up sharply. Tech, meanwhile, was held back by a slide in chip stocks as weaker than expected guidance from Micron weighed on sentiment. Micron Technology fell 3% after the chipmaker's guidance fell fiscal fourth quarter sales below Wall Street estimates on signs of softening demand. Quote, Micron's sharply reduced guidance for Q4 that assumes both bit and ASP, average selling price, declines in DRAM and NAND, I'm not quite sure what those acronyms are, due to deteriorating end markets in what is typically a seasonally stronger period, end quote, Wedbush said as it cut its price target on the chipmaker stock to $85 from $120. The softer guidance triggered selling pressures across chip stocks. Advanced Micro Devices, NVIDIA, and Texas Instruments Incorporated fell 4%, as well as a fall in chip stocks. Weakness in Alphabet and Meta also weighed on tech, with the latter reportedly set to trim hiring plans as economic recession's fears mount. The bond market was also dominating investor attention as Treasury yields continued to slip after data showed a further deterioration in the economy. Manufacturing activity in May fell to a reading of 53, missing the consensus estimate of 54.9, marking the first decline since September. Kohl's said that Vitamin Shoppe had ended its takeover pursuit of the grocery chain following a weaker retail and financial environment. Its shares are more than 15% lower. Boeing shrugged off earlier losses to trade 2% higher, even as rival Airbus secured orders for 300 jets from China's three biggest state-owned airlines at a time when Boeing's 737 MAX jets are yet to resume commercial flights in the country. In other news, General Motors rose more than 1% after reporting a fall in quarterly sales and warning of delays to deliveries as supply chain issues continue to weigh. The automaker, however, kept its guidance for the year unchanged. So, kind of a mixed bag of information. So it looks like tech is still taking quite a beating out there, but some other things are bouncing back. Seeing treasury yields fall, what that tells us is that people are buying more into the bond market. The more buying pressure you have on something, it pushes the price up. When the price goes up on bonds, the yields come down inversely. So that's how that works. All right, well, I got 3 quick articles to blaze through. See, I'm at 15 minutes, so I'm not doing too bad today, even though I'm a little out of practice. All right, first one comes from Zero Hedge. Actually, all 3 of these do. JP Morgan warns U.S., quote, perilously close to recession, end quote, as Atlanta Fed slashes Q2 GDP to negative 2.1%. This week has seen investors shift from inflation anxiety to recession fears as stocks have been hammered in bond bids and bonds bid along with rate hike expectations tumbling. The continued erosion in economic data has prompted the Atlanta Fed to slash its forecast for Q2 GDP growth to a negative 2.1%, meaning the U.S. is now technically in recession after Q1's confirmed 1.6 contraction yesterday. The GDP Now model estimate for real GDP has collapsed in recent days. Growth in the second quarter of 2022 has been cut to a contractionary negative 2.1, down from negative 1% on June 30th, which was yesterday, down from 0% on June 15th, and down from a positive 0.9 on June 6th, down from 1.3 on June 1st, and down from 1.9 on May 27th. So in a matter of a month and 4 days, the consensus on GDP for Q2 has gone from a positive almost 2 to a negative 2. So that's about a 4% swing there. So not all that great. And you can see here the little down here on this chart. This article is linked in the show notes, so you're welcome to follow along or read it at your leisure. As the Atlanta Fed notes, quote, the GDP Now models estimate for real GDP growth, a seasonally adjusted annual rate in the second quarter of 2022 is negative 2.1% as of July 1, down from 1%. Negative 1% as of June 30th. After this morning's manufacturing ISM report on business from the Institute for Supply Management and the construction report from the U.S. Census Bureau, the nowcasts of second quarter real personal consumption expenditures growth and real gross private domestic investment growth decreased from 1.7% and negative 13.2% respectively to 0.8% and negative 15.2% respectively. In short, the U.S. consumer is getting tapped out, just as we have been warning repeatedly. I think I've been saying kind of the same thing for the last year, which also fits with Jamie Dimon's recent downgrade of the economy from storm clouds to a hurricane, and also makes some sense given the recent collapse in macro data relative to expectations. Excuse me. And longer term, the trend towards stagflation could not be clearer. The Atlanta Fed's recession forecast coincides with JP Morgan's economists cutting their U.S. mid-year economic growth forecasts after an influx of weaker data this week, most notably a slowdown in consumer spending. The Wall Street Bank reduced its estimate for annualized gross domestic product to growth to 1% for the second quarter, down from 2.5% previously. This quarter is also seen at 1% down from 2%. The growth will tick up to 1.5% in the final 3 months of the year, helped by stronger car production and lower inflation, the bank's economist said. Well, that remains to be seen. Quote, our forecast comes perilously close to recession, Michael Ferraroli, JP Morgan chief economist, wrote in a note on Friday. Quote, however, we continue to look for the economy to expand, in part because we think employers may be reluctant to shed workers even in a period of soft product demand, end quote. And comes a day after Nomura called for a global recession. And this is increasingly problematic for the Fed, as the market is now betting Powell and his pals won't get close to hiking as much as they hope, all of which means the Fed is now hiking rates into a recession. So I don't know. I know I've said this a lot over the last few months, to watch what the Fed does. It'll give you kind of a clear idea of what is going to happen moving forward. If they stick to their guns and actually stick with their policy until inflation is down to a reasonable level, whatever that might be. In their mind, it's below 2%. But, if they turn tail and start slashing rates and reinstitute quantitative easing to, basically create a lot of extra or cheap capital or cheap money in the economy, it might help in the short term. We might see, a year or two, kind of like we had coming off of the Rona. We had what appeared to be a nice rally. Everything seemed okay, even though we still had supply chain problems and, little stuff here and there. But, the steam eventually runs out. And, we have to, at least in my mind, go through the downturn, recession, bear market that we were due to have going into 2020. And, COVID kind of just covered up all that. And with all the dollar creation, it really just, put a big old fat Band-Aid on a sucking chest wound. And eventually, it's not going to help very much after that. So, all right, next up, pulling back the curtain on the real U.S. economy. Revised numbers on U.S. GDP from the Bureau of Economic Analysis indicate the economy faces a deeper contraction than originally reported. GDP shrank in the first quarter of 2022 by 1.6%. This is an impressive and sharp reversal from the fourth quarter of last year, which saw GDP grow by 6.9%, due primarily to the continued circulation of COVID stimulus dollars and consumer credit spending. I think I just said that. It's also it's important to keep in mind that this plunge in GDP occurred before the Federal Reserve started raising interest rates, meaning the Fed did in fact raise rates into economic weakness, much like they did during the onset of the Great Depression, causing even more damage to the economy in the process and prolonging the effects of the crisis. The difference this time is that we do not face a standard deflationary threat, but a stagflationary one. It is a completely different ballgame. Calls for a recession are ample from mainstream financial media and many alternative analysts, though the assumption among many is that price inflation will track down as the recession pressures grow. This may not be the case. Loss of buying power in the dollar due to central bank stimulus and numerous supply chain issues indicate extended period of price inflation well into next year. Furthermore, with foreign central banks now incrementally dropping the dollar as the world reserve currency, there will be even more dollars flooding into the U.S. from overseas. That's too many dollars chasing too few goods and services. Again, that is what causes inflation. When you got lots of dollars floating around and not, you still have the same or less goods, prices are going to go up. With the decline more pronounced than initially thought, will the Fed capitulate quickly and end rate hikes? It's unlikely as long as price inflation continues through most of the economy. The Fed made it clear that they are willing to let markets take a considerable hit as they pursue deflation. Suggestions in the media that a recession will create immediate equilibrium in markets and in prices rather than ring rather hollow and naive. These are the same people that were telling us the world only a few months back that inflation was transitory. Remember that last May, a year ago? Yeah, it's just transitory. It's nothing to worry about. It's fine. It's fine. What was I saying? You print $6 trillion, you're going to have a real problem on your hands at some point in the future. And well, everything started getting more expensive late in the second half of last year. Prices on everything, especially fuel and energy, were going up well before the whole Ukraine thing. I know that some in Washington like to blame Putin for all the problems we're having today, but I don't think so. All right. Reflected in the fall in GDP is a growing concern among the public that price explosion is going to eat away at their wallets and decrease their standard of living. It is also a signal that credit cards are finally maxed out and COVID stimulus measures have finally faded away. When easy credit and stimulus move out of play and the real economy is revealed, and in our case, the true face is an ugly one. So not good there. So again, buckle up. If you ever rode the Texas Cyclone at Astroworld in Houston, it's going to be a rough and bumpy ride. So don't be shocked. All right, and more bad news coming mostly out of Europe. Rationing has already started in Europe as the entire globe plunges into a horrific economic nightmare. There was only something we could have done to avoid this. Oh yeah, don't print so much damn money. That might have been a good idea. All right. If countries in Europe are already beginning to ration certain things due to supply problems, how long will it be before it starts happening here in the United States? Up until the past couple of years, many in the Western world always considered shortages to be something that only unsophisticated poor countries on the other side of the planet had to deal with. But the last couple of years have shown us that the painful shortages can happen to wealthy countries in the Western world too. At first, we were told that they were just temporary, but the months went by and we just keep having more shortages. In fact, in 2022, supply problems have become so serious that many supermarkets in Europe have been forced to strictly ration essential items at various times. For example, it was being reported that due to the war in Ukraine, flour, sunflower oil, and sugar were all being rationed by stores in Greece. After limiting the sale of sunflowers and sunflower oil online, Greek supermarkets are turning to rationing of the sale of sugar as well, now including in their stores, over supply problems. The AB Vasipolis is setting a maximum limit on the purchase of all brands of corn and sunflower oil and of flour per customer, while MyMart put a ceiling on sunflower oil purchases, and Scalaventis has added sugar to the ration sales of corn oil through its online store with a maximum of 4 packs. Not sure how much is in a pack. The products in high demand from restaurants, which some of which said they have to stop selling French fries and other fried foods. Well, it's probably better for your gut if you don't eat too much of that. Over the past few months, we have seen similar measures implemented in other major European nations as well. For example, the war in Ukraine prompted some pretty severe rationing in Spain. Sporadic shortages of products like eggs, milk, and other dairy products also hit Spain since the war in Ukraine began. And major supermarkets, including Mercadona, my apologies on my mispronunciation. My Espanol is muy poquito at this point in my life. And Macro began rationing sunflower oil earlier this month. Now stores will temporarily be allowed to limit, quote, the number of goods that can be bought by a client, end quote, according to information in the official State Gazette published on Wednesday. Looking forward, natural gas rationing is the next big thing that many people in Europe are talking about. The flow of Russian natural gas into Europe has been cut back and appears that this may soon cause widespread rationing in Italy. Italy may start rationing natural gas consumption to certain industrial giants after Russia's Gazprom halved supplies on Friday. On the weekend, the newspaper Corriere della Sera reported that the Italian government and energy industry would meet Tuesday and Wednesday to discuss the crisis, with the likely outcome being the introduction of a state of alert under the country's gas emergency protocol. And CNN is reporting that Germany is, quote, one step closer to rationing supplies, end quote, now that Russia has decided to reduce the flow of natural gas going to that country. Well, I thought Russia was going to cut, or Europe was cutting off Russian natural gas and are all, basically everything from Russia. So they're still taking it. I bet they'll be happy to get that Russian gas when, it's January and you're freezing in Northern Europe. Anyways, let's see here. Of course, there are other parts of the globe that are dealing with problems that are far, far more serious than what Europe is facing right now. As I discussed in an article that I posted a week earlier, significant numbers of people are starting to literally drop dead from starvation in portions of Eastern Africa. Global food supplies are just getting tighter, and the head of the UN is openly telling us that the world is heading into an unprecedented global hunger crisis, end quote. So if you have plenty of food to eat tonight, you should be thankful. Here in the United States, economic conditions are deteriorating fairly rapidly, and most Americans are completely and totally unprepared for any sort of major economic downturn. Earlier today, I came across yet another survey that shows that about 60% of all Americans are currently living paycheck to paycheck. Quote, we find that consumers in all income brackets, including those who make more than $100,000 annually, are living paycheck to paycheck. Payments, PYMNTS payments. Research finds that 61% of U.S. consumers were living paycheck to paycheck in April of 2022, marking a 9 percentage point increase from 52% in April of 2021, meaning that approximately 3 in 5 U.S. consumers devote nearly all of their salaries to expenses, with little to nothing over at the end of the month, end quote. So what's going to happen when those people start losing jobs in large numbers? Time to prepare. Already, we have seen a number of tech layoffs greatly accelerate over the past couple of months. Sadly, the layoffs will get much worse in the months ahead. And as inflation continues to systematically eat away at our standard of living, Americans are turning to credit cards at a record pace. As Americans grapple with the highest inflation in 40 years, the number of new credit cards have surged as more Americans rely on them to keep up with high prices. According to a recent report from the Federal Reserve, revolving credit cards and lines of credit increased by 19.6% from the previous year to $1.103 trillion. Going into credit card debt is not a solution, and as a former debt and recovery collector, I can attest to that. When the economy is bad, being in over leverage is a real bad idea. At best, it can buy you a little time, and it's especially a bad idea to go into credit card debt as we plunge into a recession. At this point, almost everyone realizes that things are going to get bad. According to a recent poll, a whopping 85% of all Americans believe that the U.S. is, quote, headed in the wrong direction. The national dissatisfaction is bipartisan. Most Americans, 85%, say the country is headed in the wrong direction. A majority of Republicans have been unhappy with the direction of the country since Biden's election. Democrats have been positive about how things were going, but now 78% say the country is headed in the wrong direction. So, wow, 78% Democrats. That's pretty big. I was astounded to see that 78% of Democrats believe that the U.S. is headed in the wrong direction, with a Democrat in the White House and a Democrat House and a split Senate. I've never seen a number like that ever before, but this is just another indication that the hour is late and that things are about to start getting really crazy out there. For the moment, life is still at least somewhat normal in the Western world. Sadly, it won't stay that way for long. And so I would recommend using your time wisely. So what I would recommend is now is the time to get your crap together. If we experience some food shocks or shortages, here in the near future, have a few, at least 90 days worth of extra food. I mean, obviously you're not going to have the fancy stuff, but, things that store well, beans, rice, things that, you can keep in your cupboard for years and never have to worry about them. But if things go really bad, having means to, have, 1,000 or so calories to be able to consume a day is nice. Be able to make water, have some water filtration, just the very basics, and once you have that, get your debts paid off, or at least get them under control for now. If you're in a job market that, or if you're in a industry that may or may not be around when things get really, really tough, now's the time to really start looking for, employment in a field that, will be more stable. But if anyone has any concerns or worries, feel free to give me a call. All my information is at dsafinancialgroup.com. My email address is right here on the screen, so you can see it. You can send me an email, say, hey, Ray, I'd like to book a meeting. I'd be happy to sit down and talk it over with you and see if I can be of any help. If I can't, I'll at least send you off to someone that can. So, all right. Well, that's everything I had for the week. Wow, I went over 30 minutes. 15 minutes reading articles. But anyways, so I hope everyone has a fantastic, it's another holiday weekend. We had one 2 weeks ago. So the week I was in New Hampshire was a short week. And then this week was a regular week. And then next week we're back to a short week. So, but, hope everyone has a lot of fun. Be careful if you're playing with fireworks. You don't want to blow off your fingers. And, like I said, if anybody needs anything from me, please go to my website and, you can get in contact with me. All my my email, phone numbers, and all that good stuff is there. And even a link to book a meeting directly from the site. So, all right. Well, hope everyone has a great weekend, and I will talk to you guys on Tuesday. Bye-bye.